Hi everyone, thanks for coming back. We are discussing the power of long-term investing in FlexiCap funds is often underestimated. Today we are going to discuss about funds performance compared to index BSE10 index. Also, please make a note, past performance is not guaranteed as future performance. This is just for information for investors which we are discussing and comparing. The SIP performance of the selected funds is typically compared against the SIP returns of the BSE 100 and other relevant market indices over the same investment period. This comparison helps to highlight whether the active management and flexible mandate of these funds added value over a passive SIP in the broader market. The HDFC FlexiCap Fund's exceptional SIP performance serves as a strong indicator of its ability to generate significant wealth through the mechanism of rupee cost averaging. One catch here is during May 1995, rupees 5,000 is equivalent to half of the monthly salary which is used as a SIP investment. So in today's term, if someone is earning 50,000 per month, he should have 25,000 as monthly SIP. If he earns 1 lakh per month, then rupees 50,000 monthly SIP is required for next 30 years for someone starting SIP. While specific benchmark SIP figures are not explicitly provided in the available information for a direct comparison, historical market trends suggest that actively managed funds with flexible mandates have the potential to outperform passive index SIPs over the long term, especially by tactically navigating different market capitalization segments. Here BSE 100 index returned 3.9 CR, but our funds combined returned 12.9 crore with same investment of 73 lakhs as part of monthly SIP for last 30 years. Similarly, when we compare lump sum returns, here BSE 10 index returned 58 lakhs, but our funds combined returned 2.5 crore with same investment of 7 lakhs as part of 1 lakh investment in each fund on May 1995. One time lump sum 30 years back and reinvesting the dividend received from UTI fund, which amounts to 5 lakhs dividend reinvestment amount. Performance across different market conditions. The comparative analysis of lump sum and SIP investments reveals distinct performance characteristics across various market cycles that have occurred over the 30-year period. A lump sum investment generally performs exceptionally well if it is strategically placed at or near a market low. This allows the entire capital to fully capitalize on the subsequent bull run, leading to maximized returns. However, this approach inherently carries significant risk if the investment is made just before a major market correction, such as the 2008 global financial crisis or the 2020 COVID-19 crash. In such scenarios, the entire capital is exposed to immediate and substantial drawdowns, which can be psychologically challenging for investors and may lead to premature redemptions. In contrast, a systematic investment plan inherently benefits from rupee cost averaging. This mechanism involves investing a fixed amount periodically, regardless of market conditions. This systematic approach allows investors to accumulate more units when market prices are low and fewer units when prices are high. This strategy effectively helps in smoothing out returns over time and significantly reduces the impact of short-term market volatility. Consequently, SIPs often lead to competitive or even superior returns compared to lump sum investments, particularly during prolonged volatile or sideways markets, where continuous buying at different price points averages out the cost. Role of rupee cost averaging versus market timing. The analysis underscores that SIP inherently incorporates the principle of rupee cost averaging, which largely removes the need for market timing. Market timing, the attempt to predict market highs and lows to buy low and sell high, is notoriously difficult and rarely successful, even for seasoned financial professionals. The Indian market's 30-year history includes multiple instances of sharp corrections and rapid recoveries, making consistent market timing practically impossible for most investors. Lump sum investing, while offering the potential for maximized returns if timed perfectly, inherently carries significant market timing risk. An investor who deploys a large sum just before a downturn could face substantial paper losses, potentially leading to anxiety and suboptimal decisions. The consistent nature of SIPs, especially during periods of market stress, transforms what might be perceived as losses for a lump sum investor into opportunities for accumulation for a SIP investor. When market NAV is full, the fixed SIP amount purchases more units, effectively averaging down the overall cost of investment. When the market subsequently recovers, these additional units, acquired at lower prices, contribute disproportionately to the overall portfolio's appreciation. This mechanism mitigates the severe impact that a lump sum investment made just before a market peak would experience. While a lump sum invested at a market trough would yield the highest possible returns, consistently identifying such troughs is practically impossible for most investors. This inherent benefit of rupee cost averaging makes SIP a more resilient and less stressful investment strategy for long-term wealth creation, especially for retail investors with regular income streams. It emphasizes the importance of consistent participation in the market over attempts to predict its short-term movements. Thanks for watching. In next session, we will further discuss on new topics related to these funds. See you soon.